Welcome back. This is episode 7 of the Fostering Financial Victories podcast. So I feel like we should start this off with one of those emergency broadcast beacons that you hear running down the road when the weather's changing. But I don't think everybody wants to hear me do that. So this is out of our normal schedule. So what we are going to do today, I'm joined by Baughman. He is the Chief Investment Officer of the Foster Victor Wealth Advisors team. And we are going to talk through some of the recent craziness that we've experienced in the last couple of weeks. So this is going to be a shorter episode, and our goal is that what we want to do is to talk through and give some clarity on what we're currently seeing and give you some ideas and provide some insight on what you may or may not need to be doing right now. We're getting a lot of questions. I'm sure everybody else is talking to their friends and say, hey, what are we doing? What do we need to do? So Rand, thanks for joining us. Let's get right into it. So what have we seen in the last 2 weeks?
The F word I'm choosing to use for it is fun. It's definitely been a fun few weeks. But obviously we're seeing an extreme downturn. We're seeing the markets drop from their all-time high on February 19th and drop quickly. And it's frightening. It's frightening because there's not end in sight in the moment. It's frightening because it's hard to see in the moment. But what we do need to go back to is just go back to even though our feelings, our emotions are scared or frightened right now in the moment, we just got to go back to, okay, why did we invest dollars in the first place? What was the purpose of those dollars that were invested?
Yep.
And what was the process behind how we chose the investment strategy around those dollars? Was it built around a financial plan that was, that you spent, 3, 4, 5 meetings that were 90 minutes each to develop, or was the investment strategy built around a guess, around an assumption, around speculation? Yeah. And I think we just got to go back to that because what we're seeing with our clientele, which is pretty cool, but also just looking at the markets as far as who is actually selling out. Honestly, it's not the long-term investors. It's not the ones who are investing for the long term. It's more the short-term investors. Jeffrey Kleintop, Schwab's chief global economist, did a nice piece that he sent out yesterday, just talking about, okay, what type of investments are seeing the outflows. It's not the long-term hold strategies. It's more of the day trading, leveraged ETF type strategies, which I thought was interesting.
Yeah. So you see a lot of the news that's coming out recently, and all the talking heads are saying, hey, this is an unprecedented deal. We've never seen anything like this. Is there anything you can compare this time in history to any of these other downturns that we have seen in the market, whether it be 2001 or 2008 or something back in the mortgage crisis time frame? Anything that is comparable?
So I would say the main thing that is comparable is I would ask investors to go back to 2008, go back to 2001. What were your thoughts in that time frame? What were your feelings in that time frame? Did you also think that that was unprecedented times as well? The reason being is because I remember in 2008, unprecedented. Banks are collapsing. Large, well-established companies are needing bailouts. Like it was unprecedented times then. But what we have to go back to is, like right now, it is unprecedented. It's something that we've never seen before. We've never seen the widespread just spread of a virus like this. We've never seen a virus that is so hard to control or contain. Number one, if they're going to actually see a reduction in profit, probably are. Who knows? But we don't know how long it's going to take for them to come back. So what we have to go back to is, okay, again, when I invested dollars, why did I do it?
Right.
What was the time horizon? Was it, again, built around a financial plan? Even then, like just looking at past downturns. So J.P. Morgan, they sent out a nice piece. It's called their Guide to the Markets, and we're going to try to throw this up on the screen.
Yeah.
But it talks about the last 12 bear markets, and what's interesting is that on average, those bear markets last 22 months. So I think we just got to go back to that because it's 2008 felt a lot longer than 20.
It did, yeah. And you look at the graphs on 2008, you really only see one downturn year when you look at it year by year, which I don't think most people would go back and think, oh, it was only down once and the rest of the year was up. It doesn't feel that way, thinking back, but when you look at the numbers, it is a little bit surprising. The one thing that we're starting to look at is we've been in a bull market for how long?
Technically, the bull market started in March of 2009. That was the technical start of the bull market.
That's unbelievable.
Yeah,
I would say that might be unprecedented, right?
That was, I believe, that was the longest in U.S. history.
Okay, so that unprecedented word gets tossed around a lot. It's heavy. It sounds a little bit catchy, but we just came out of something that was highly unusual.
Well, not only that, but also it makes sense for us as investors to think that right now is unprecedented.
Sure.
Because there's something that we as investors, we as humans have. It's called recency bias. All that is the results that we see the most recent, we tend to think that those are the norm. And so what I mean by that is, again, a nice, first of all, I'm sorry, I love charts and graphs. So if I start going down the weeds, just wave the white flag.
And I think if people have the ability to go to the YouTube site and watch this, you'll be able to see these graphs. We'll also have them linked in the notes section of this episode, so you can access that as well. Yeah. But yeah, go right ahead.
Well, what's interesting is on this. So we have the S&P 500 returns dating back to 1980, and you see positive years, negative years, obviously. But what's really cool about this, I think, is that it also shows the intra-year drawdown. So what that means is, like, for example, let's look at 2019, for example. So the S&P ended 29% positive, but during the year, there was an intra-year drawdown of -7%.
Really?
Yeah.
I wouldn't think most people would remember that because of the returns being so high and so good last year.
Well, not only that, but if you look at the average intra-year drawdown is 13.8%. So if we look at more recent years, so 2019, 2017, 2016, 14, 13, 12, all of those years, the intra-year drawdowns were less than the average, the historical average.
Okay.
So there is a little bit of recency bias in place where, we haven't seen a drawdown like we've experienced now, obviously, but also we as investors sometimes can get complacent and honestly, again, we're just humans. We can get greedy and we think everything's going to go up, and that's just not the case.
And get emotional about it, I think, is the worst thing that can happen right now, right? So the data always comes back to, and that's why you do such a good job in our office of keeping everybody level-headed on times like this, because you do go back to the data. Yeah. And that's all we can really use because there's no way you can predict what's going to happen even today. So we're sitting here at 8:20 on March the 19th. The market hasn't opened yet for today, but it's been like a pinball all week long and last week as well, with no prediction whatsoever what the day is going to bring.
Yeah, and that's nobody knows. At the end of the day, and that's another good reminder is that investments are unpredictable.
Sure.
But they do tend to revert back to their mean. And again, going back to why are we investing the money? If we look at ourselves in the mirror and we're honest with ourselves and we truly invested for a 5+ year time horizon, I don't want to say who cares what it's doing now, because that's not the case.
Sure.
But we don't need to touch the money for 5+ years, and the probability of that having a positive return is about 88%.
So talk a little more about that with the odds of. So I know we've looked at this internally within our office. Give me some background on the odds of a positive return. Yeah,
so the odds of a positive return, you increase those odds with the longer your time horizon is. So we also have another nice charts and graph from this time from BlackRock. So the odds of a positive return, again, positive, so greater than zero.
Just over zero.
Just to be clear, greater than zero.
Not
right?
30%.
Yeah, just greater than zero. So on a 1 month time horizon, the odds of a positive return are 62.4%.
Okay.
So better than 50, but it's pretty much coin flip. On a 1 year time horizon, the odds of a positive return are about 75%. But where we see those odds really start to get significant are on a 5 and 10 year time horizon. So on a 5 year time horizon, the odds of a positive return are 88.8%.
That's pretty good odds.
It
Yeah.
gets better. On a 10 year time horizon, the odds of a positive return are 94.6%. Again,
Okay.
the definition of positive greater than zero.
Just more than what you put in.
But that's why we're investing.
Right.
We're investing money to increase that money.
Right.
And so that's why, honestly, time horizon is the most important thing.
Got it. Okay. So the short-term results being the most unpredictable in that setting of information you just gave us, but long-term, if you stay the course, history has proven, for the most part, that it will reward you.
Yeah, and trust me, much easier said than done.
So that gets us into this reaction, this emotional reaction versus a reasonable approach to this. Yeah. So what should people be thinking about right now? I know we've heard it a lot. Hey, should I go to cash? What should I be thinking from an investment standpoint? What does a knee-jerk reaction typically look like when markets go down?
So there's a couple of knee-jerk reactions when the markets go down. The first knee-jerk reaction is to sell out and go to cash. And what we know, just based on the extensive research that we've done, and also based on the extensive books that we've read from really successful investors like Warren Buffett, John Bogle, founder of Vanguard, Peter Lynch, is that isn't a strategy. That's a reaction. And the reason why is because it's so much easier to pull the trigger on going to cash. It's much harder once you do that to pull the trigger and invest back in. The rationale is, hey, I'm gonna go to cash and I'm gonna get back in when the market bottoms.
Sure.
But what's interesting is I actually was talking with Paul Foster about this morning, going back to the JP Morgan chart. The bull market started in May of 2009. But we don't know the bull market started in May 2009. So if we go back to that time period, we don't know when the bull market starts.
Yeah.
So how do you know to get money back in?
Well, and I'm looking at that chart you brought in with the intra-year downturns. It was minus 28% at some point in 2009, but it finished 23% up.
Yeah.
So you're right. So what I'm hearing is that the easy decision is to say, all right, I push the button. I'm going to get out of the market right now because it's scary. It's going the opposite direction. I'm not comfortable with it. But now you put yourself in a position where you've got to be dead on it from a decision-making position on the second go-around to where you know when to get back in.
And it's so much harder. Like talking with some people that I really trust, who did get out of the market in 2008, because it's so much harder to get back in, and there's so much doubt of getting back in once that happens. Some of them didn't get back in until 2012, 2013. And
they've missed 3 or 4 years of a bull market.
Now it's one sample size,
sure,
right? But still, it's just human emotion is a real thing.
Sure.
It's hard.
So the panic that some people may be feeling right now from an investment perspective. What it seems to me, and hearing you talk about this, and I know we've talked about this ad nauseum inside our office, is that the decisions that you made initially were made without emotion being present. Right? So you made the decisions to put money into the market in a certain allocation for a specific time frame of when you're going to access those dollars. As hard as it is right now, avoiding that panic knee-jerk reaction historically should pay dividends going forward. And while we say that that's a really hard thing to do, are there any opportunities? So let's kind of flip it a little bit to say, well, all right, well, the market's seeing a depressed value right now. Are there any things that people should be looking to take advantage of? Right? So never let a good crisis go to waste, in a sense. But somebody who's in their 30s and 40s, what should their approach be versus somebody who is at or near retirement?
Yeah, that's a great question. So for someone in 30s and 40s, call it the accumulation phase of life. It is a good time to invest money, but we don't want to be reactive that way either. We want to do our due diligence. And what I mean by that is just because it's a good time to invest money doesn't mean if you look at your own personal situation and your own plan, you should invest money, because you want to vet a couple things. First and foremost, you don't want to invest cash you have that's in excess of your emergency fund. You always want to hold your emergency fund because you don't want to dip below that. The second thing is if you have excess cash above your emergency fund, take your time, do your due diligence on the investments you want to invest in. Think about this as a 5+ year time horizon. So take your time, do your due diligence. Don't rush into it. Don't rush into an investment because you read or you heard that, hey, this stock's depressed, this sector's depressed, it's got to come back. Just take your time. There's no rush. Do your due diligence. But once you do decide to pull the trigger and don't look back. The reason being is because hindsight is always 20/20,
sure.
Whether it's a positive 20/20 or negative 20/20. So like, for example, right now, let's say, so it's March 19th. Let's say we were to invest money March 19th. If I told you 2 months ago that in 2 months you're going to be able to invest in the market at prices of the Dow 2 months from now that they were in 2017, would you think that's a good buy? Probably so.
Probably so, yeah.
Regardless of if it continues to go down, we just got to have faith in the future,
sure.
Faith in that time horizon. But again, once you've done your due diligence and you choose to pull the trigger and invest, do it and trust it. Don't look back, because if we look back and we start watching it and then the emotion sets in and it goes down over the next 2 weeks, 3 months, it's like, oh man, that was the wrong time. Let me sell out. And that's
you missed it.
Yeah. But you didn't miss it. It's always, again, time horizon, regardless of what point you put in, is the biggest thing.
So that's somebody in their accumulation phase of life still. What do we see for the person who is in retirement or very close to retirement? I know they're looking at this way different from a perspective standpoint. So you and I are still in that accumulation phase. You know, we get to learn from our older clients who are at that retirement part of their life on what they like and what they don't like now. What should they be thinking about currently?
Yeah, so things to think about currently are, number one, looking at your current expenses, your current living expenses. What we would recommend is having almost like a needs budget, I'll call it, and a wants budget. The wants is, okay, we're going to travel, we're going to give to grandkids, we're going to give to kids, we're going to pay for this. That's like the wants. It's got the excess expenses that we want to do, right? And that's what we'll do, honestly, 5 out of 6 years. But the needs base is, okay, if the market goes down and we need to skinny up, the needs base is things we can cut out just for a year, if just for a short time period.
Sure.
To let everything come back. So that way we're not taking as much out of the investment portfolios. That's something, and I'd recommend looking at.
So if somebody who is in that position where they are in that spending and consumption mode of life and not the saving side of things, let's say they absolutely are in a need to pull cash and spend because that's going to keep the lights on, that needs budget just runs on that. Are there any strategies on how they can look to access cash, given that the market's down? Anything they should absolutely try to avoid if at all possible?
Yeah, so the thing to avoid, if at all possible, is selling your investment assets, investment holdings at depressed values in order to raise money for living expenses.
Okay. Because
that's what we call negative compounding. So like, for example, let's say your living expenses are 4% of your portfolio and the market goes down 30%. Your portfolio didn't just go down 30%, it went down 34+%, right? Yeah. So that's negative compounding. And other things to vet, again, don't rush into it, do your due diligence, talk with your personal advisors, run it by them. But like something like if you have equity in your house, maybe just opening a home equity line as like a last case emergency fund. Not saying tap into it, but as a last resort emergency fund, where if you're cash in the bank, if you're getting close to spending all of that, and all the investment accounts are at depressed values, then we tap into the home equity line just for a short time period until the investments come back, and then we replenish. But that's something to consider. If you have any sort of non-correlating assets to the market, so non-correlating would be something like a fixed annuity that's non-correlated to the market, or like a cash value life insurance. That's not a variable life insurance product.
Right.
Anything like that might be another way to have dollars you can pull from and not to sell investment. But I can't reiterate enough, cross-reference with your trusted advisor, and because honestly, they've done a plan for you for like the last 5, 6, 7, 8, 9, 10 years you've been working with them.
Yeah.
And that plan factors in events like this. It factored in a 2008, it factored in a 2000. And that plan is so important. So don't rush to anything, take your time, and make a decision from there.
Yeah, take a deep breath.
Yeah, take
a deep breath.
I mean,
okay, so you mentioned earlier there are some opportunities to put cash into the market because it's a depressed value. What if somebody doesn't have just idle cash sitting around? Is there any way they can take advantage of this?
Yeah, that's a great question. So one great way to take advantage of investing money in the market currently, if there's no extra cash, is if you have like a 401k or like a simple IRA through your employer, consider pre-funding the contributions for the year. What I mean by that is let's say you're maxing out your 401k at $19,500 per year. And so far this year, you've contributed, let's say, $5,000. Mm-hmm. Take the difference and pre-fund that over the next few months. Now, before you do that, consider the impact on your paycheck over those months.
Cash flow.
Because it's gonna come for your paycheck. But that's a way to get money in the market quicker.
Without having to exhaust that emergency fund.
But also, those accounts anyway are extremely long term because you really don't want to touch those until 59.5 anyway.
Right.
So
might be the best place to do it if you can do it right now because it's going to force you to leave it alone.
Yeah. Yeah.
Okay. So that sounds a little bit counterintuitive to the theory of using dollar cost averaging. So if somebody on the other side of this is sitting there with a lump sum of cash, what should maybe their strategy look like? Should they do the dollar cost averaging method where they're putting it in every month in the same day, or should they take a different approach at this point given where the markets are?
Yeah, what we've seen is dollar cost averaging. It works and wins over like 30 plus years.
Okay.
So what I mean by that is let's say we had a lump sum of $20,000, let's say, and we wanted to do 5,000 month 1, month 2, month 3, month 4. It's honestly a coin flip whether you're going to come out ahead doing it that way or doing the lump sum. So then it just comes down to, okay, comfort level. Am I more comfortable putting that lump sum in the market now, or am I more comfortable dollar cost averaging in over 4 months? If it were me, I'd recommend doing the lump sum, because if I'm putting the money in the account, I've already made the decision it's money in excess of my emergency fund. I've already made the decision it's a 5+ year time horizon. Let's go, baby. Let's invest that money. Let's get it to work.
Let it get after it.
I don't like taking the odds of a coin flip.
Okay. And you're saying because of the 4 months, it's just not enough time frame to give the market a lot of time to move, like it would be over 30 years.
Exactly. Because also, like, based on past bear markets, when it comes back quick, and we just don't know when it's going to come back.
Okay. Are there any indicators? And I'm not going to hold you to this, and hopefully nobody else will either. But is there anything from a data perspective that we could look at currently that says this might be the end of this turbulence? Is there anything that we could point to that could be that bookend? What
we're tracking, and this is, again, complete guess, shot in the dark. But what we're tracking is based on past pandemics. What we've seen through the data that we researched is that usually the market bottoms out, again, usually when the number of new cases flattens out. Usually that's the case.
Okay.
So what we've started tracking over the last 2 weeks is the number of new cases in the U.S. And just to give us an idea, okay, where are we at with this? Where the market's at with this? And again, no idea if that's the absolute bottom, but that's best guess.
But it's data that we could pull from other instances that were similar to this, even though, I mean, you and I have never seen what we're seeing right now, where people are, being told to stay home. And, I don't think we've got the 4 to 5 foot radius here from a social distancing, but we're pretty close. There's somebody else in here.
No.
But again, unusual circumstances, but historically data is what we can go back on. So that's great. I think that's good feedback.
Again, best guess. So just don't.
Yeah, not going to hold you to it.
Nope.
Well, Rand, let's stop it here. I know you've got a busy day ahead. You've got about 50 minutes before the market opens.
An idea is to, as investors, to start an investment journal.
Like a diary?
Okay. Like a diary, okay. And just write down over the next few days, next few weeks, next few months, what are your feelings about the market day to day? What are the decisions that you are considering on a day-to-day basis? What were the decisions that you decided to execute and implement? Good to go, let it sit. Then towards the end of the year, revisit the diary. Okay, were those decisions the right decisions?
Yeah.
Who knows? Were the feelings that I was feeling, were they warranted feelings or were they not warranted feelings? But also I'd recommend going back to 6 months ago. So 6 months ago when everything was flying high, what were the decisions that I was making? What were the feelings that I was feeling? The reason why is because if we look at the history of the markets, really on average about once every 6 years, there is some sort of downturn. It's not as extreme as like what we're experiencing now or 2008, but there's some sort of downturn. And I think it'd be really nice to have that journal to go back to it. So when you start, feeling, all right, everything is going to go up. I'm going to increase my risk tolerance, my portfolio. I'm going to start, being speculative. Maybe that's a sign of, hey.
Maybe you should go back and read what you wrote.
Or when it's a downturn, I want to sell out. I want to do this.
That makes sense.
Yeah,
just give you some perspective because people have short memories.
Yeah.
Okay, I think that's great. Yeah. Well, folks, I hope this has been helpful. Please just take a deep breath. We're going to be okay. Yeah. It's not all doom and gloom, but if you want to reach out to us, if you have any other questions, we're happy to help. You can find us through our website. You can go to fostervictorwa.com. You can email us directly from there. If you would like a wealth coach to reach out to you and answer some questions, we're happy to do so. You can also follow us on Instagram at Foster Victor Wealth Advisors. Please share this with anyone who you guys have been talking from hey, what to do. And let us know if you have any questions or suggestions on how we can help explain anything else. Thanks for spending some time with us, Rand. I know you got a busy day.
Thank you.
Information contained in this podcast was intended for general use, not to be used as specific advice. For content tailored to your personal situation, please contact one of our wealth coaches.